Each currency belongs to a country or region. So Forex fundamental analysis focuses on the overall state of a country's economy, such as productivity, employment, manufacturing, international trade, interest rates, and some other things as well. So we're going to want to cover more on fundamental analysis later, but let's look at a few basic examples of how it works. Take this example of the Euro USD. The euro is the base currency and thus the basis for the buy-sell, right? Like we learned in the last section. If you believe that the US economy will continue to weaken, which is bad for the US dollar and good for the euro, you would execute a buy order, right? So by doing this, you've bought euros in the expectation that they will continue to rise versus the US dollar. Now, the opposite, if you believe that the US economy is strong and the euro will continue to weaken against the US dollar, you would execute a sell euro USD order. So by doing this, you've sold the euro because you're expecting it to continue to fall versus the US dollar. Or in this example of USD JPY, the US dollar is the base currency, right? So it's the basis for the buy-sell. If you think that the Japanese government is going to weaken the yen in order to help its export industry, let's say, then you would execute a buy order, right? Because the USD is going to go up in value compared to the Japanese yen. But if you believe that Japanese investors are going to pull money out of the US financial markets and convert all their US dollars back to yen, that's going to hurt the US dollar, right? So the JPY is going to go up in value compared to the USD, and so you would execute a sell order. By doing this, you've sold US dollars expecting that they'll depreciate against the Japanese yen. Last example here, we have GBP USD. So this is the pound, that's the base currency, and so it's the basis for the buy-sell. So if you think that the British economy will continue to do better than the US in terms of economic growth, you would execute a buy GBP USD order because you're buying pounds expecting that they will rise versus the US dollar. But if you believe the British economy is slowing while the American economy remains strong and is going to continue to remain strong, then the GBP is going to go down in value compared to the USD that's going to go up in value. And so you would execute a sell order on GBP USD because this way you would sell pounds expecting that they're going to depreciate against the US dollar. So now I want to talk about something that's really important and really cool about Forex that's called margin trading. And I want to start off by comparing this to when you go to the grocery store. Let's say that you want to buy just one egg. It's going to be kind of hard, right? Because eggs don't come in just single packs. Eggs come in dozens, or in this case, we're going to call them lots of 12. In Forex, it's the exact same. You would never buy or sell just €1. In Forex, they come in lots of 1,000 units of currency, 10,000 units, or 100,000 units, depending on the broker you're using and the type of account you have. So we're going to talk more about lots later, but maybe you're thinking, I don't have enough money to buy 10,000 euros. But guess what? You can still trade with something called margin trading. Margin trading is basically just trading with borrowed capital. Through margin trading, you can open a $2,500 position with just $50 or a $50,000 position with just $500. And this is good news for you because it means that you can conduct relatively large transactions very quickly and cheaply with a small amount of initial capital. Now, what happens is your small capital is set aside as a deposit to be able to trade with a lot more money. Once you decide to close your position, close your trade, that deposit that was set aside will be returned to you and a calculation of your profits or losses is done. Your profit or losses are then credited back to your account, and this is why it's possible to get huge returns in Forex if you trade successfully. And that's the point of this whole course of everything we have in Blue Edge Financial is to help you trade successfully. So we'll look at another quick example. We looked at one earlier in a different section, but let's say you want to buy 100,000 pounds and you only have to put up like $1,000 in order to do that. So you trade with 100,000 pounds at the exchange rate of 1.4, which is equal to $140,000 in this case. 5 minutes later, let's say that the exchange rate goes up for the GBP USD, and now it's 1.4050. So you decide, hey, it went up. I'm going to go ahead and sell. And now when you sell these pounds, they're going to convert to $140,500. So you can see $500 more than 5 minutes ago. This would give you a profit of $500 with just a deposit of $1,000 in order to trade with that 100,000 pounds. Pretty crazy, right? The last thing I want to talk about in this section is called rollover. If you have any trades open at the broker's cutoff time, which is usually around 5 o'clock Eastern for the United States, then there's going to be what's called a daily rollover interest rate that you as a trader have to either pay or earn. So if you just want to avoid this completely and you don't want to pay interest or earn interest on your trades, just make sure they're all closed before 5 p.m. Eastern. And as you start trading, you're going to see how this works. You'll see what's called a swap fee, which is this fee for the rollover that the broker charges. So as you start trading, you'll learn more, you'll see this happening, and you'll get used to it and make a decision whether or not you want to close your trades before the rollover or not. So how does this work exactly? Let's say you were buying a currency with a higher interest rate than the one you were borrowing. Then the net interest rate differential will be positive. So for example, USD JPY, you can see JPY is negative 0.1% and USD can be 2.5% or less than that as well. So that would earn you interest as a result. But on the other end, if the interest rate differential is negative, then you will have to pay. Many retail brokers adjust their rollover rates based on other factors, so it won't always be a perfect science, but you can check that information with your broker and figure that out yourself. In the meantime, this is a chart that can help you figure out the interest rate differentials of the major currencies. This chart is accurate as of February 2019, so by the time you're watching this, it might have changed. But basically, this is just something to be aware of, that there is this rollover or this swap fee that the broker charges at 5 o'clock Eastern if you have any open trades. It's not necessarily a bad thing. Sometimes holding your trade through until the next day is going to be worth it because the market might change and it'll more than pay for that swap fee. You'll end up finding that you'll just make that decision as you start manually trading, getting used to it, and really just knowing when that rollover is the most important thing for now at 5 o'clock p.m. Eastern time for the United States. So that's all for this section. We'll see you in the next section.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.